Markets are looking for some direction after those July minutes yesterday. Here with more insight. Let's give us some direction. David Bailin is Citi Global Wealth's Chief Investment Officer. It's great to have you here. Welcome.
Thank you.
A lot of people saying those minutes were kind of surprisingly hawkish. Was that your read?
Yeah, that is my read, and that's why the bond market is reacting, the way it is. But the bond market's also presenting us with an incredible opportunity because the minutes are looking backwards, and when we look ahead to 2024, we're going to see inflation fall substantially. And you rarely get an opportunity to buy bonds with these kinds of real yields in them.
I know you are walking right into it.
I am well aware of that. Yes, indeed.
So isn't low inflation already priced into the market? Like it wouldn't. Do you think that the 10-year yield is where it is because it thinks the CPI is going to be 5% instead of 3% next year?
I think that when we look at where the CPI is going to be next year, it's going to be somewhere between, by the end of 2024, at 2.5% to 3%. That's
versus where do you think the market is?
Well, the market thinks, it's going to stay probably around 4% based on where we are right now. But what's clear is that the last remaining part of inflation, which is related to real estate, is what's going to come down next year. Mortgage rates, which are unusually high.
But everybody knows that. Or, I mean, we've all seen the data, right? So that's my question is why, because what I'm really trying to figure out, which is what we've all been, why are bond yields so high, right? Are there just enough people in the market who don't believe that it's going to go that direction?
That is exactly right. I think that's the huge debate, right? You have a whole bunch of people who believe that inflation is going to be persistent and that it is simply, embedded into the economy. And when you look at it, and a whole bunch that aren't. And the other thing I would also say is that there's a huge amount of cash on the sidelines. The average ultra-high net worth investor has 15 to 20% of their money in cash. They're sitting there taking the short-term view. They're piling into notes, piling into short duration treasuries. And they're not looking at where else they can move their money. And it's one of the biggest calls that we have right now. It's sort of like I say to people, you can get 5% for 6 months, or you can get 6% for 5 years. Which should you do?
Where are you getting 6% for 5 years?
Well, obviously in corporate bond markets, not in the treasury markets. But that's my point, is that people should be moving out in duration right now to intermediate or longer bonds. And in order to do that, you have to believe that inflation is going to normalize.
But the average household might be, okay, if you have a financial advisor or you're ultra net worth, fine, you can buy corporate bonds. But for everybody else, they're probably just saying, well, Treasury market's a pretty good proxy, and I'll take that, and maybe I get, 4.5, not quite, instead of 6.
Right, and again, I just don't see a whole lot of people buying intermediate and long duration bonds. That's really what's taking place. And so, it really is a debate on inflation, and I think the data is unequivocal that with the exception of real estate, which is going to be the lagging impact, you'll have lower inflation next year.
Got a lot of money left to spend.
A lot of money.
No,
right.
on infrastructure. The government does.
That's correct.
On infrastructure. Did you see manufacturing, factory construction? It's up like 100%.
Right.
I mean, they're giving away money to people to subsidize industries. And we're just getting started with this. You don't think that keeps the job market tight? And plus, we're also investing in things that are going to be more expensive. Like chips built here are going to be more expensive. Renewable energy, $1.2 trillion we're spending on that over the next few years. That's all going to be more expensive.
Right. So there's no question, that if you take a look at COVID spending, you take a look at government spending on infrastructure, right, Inflation Reduction Act, all of that, right, and the lagging impact of what took place, from COVID till now. There's no doubt that we're going to be doing that. There are parts of the economy, however, that are structurally deflationary, right? All of the stuff with green energy is actually now becoming very real. You're able to produce energy at lower costs. That's going to keep the cost of energy down. You're seeing real wages, right? Right now, real wages are actually up.
But oil's back to 85, and renewable energy isn't cheap. It's more expensive.
No, renewable energy, per unit of kilowatt power is clearly being produced at well under the price of oil today. And you're seeing an enormous shift in that area.
We just don't use it 100% of the time.
No, of course not. But these things are 20-year. These things are 20-year shifts. And the larger issue, when you look at the components of the economy, you just saw Walmart's stuff. Inventories are coming down, right? They were very, very high. Manufacturing levels in the United States are below average right now.
Goods piece is deflating, but without a slow labor. I mean, do you expect the labor market to be a lot worse off next year than this year? Because how do you get to 2-3% without wages basically running at that level?
Well, that's where they're ultimately going to end up running to. I mean, that's where they're heading to. I mean, you look at these interest rates and you look at how resilient hiring has been. No question, it's exceeded expectations, right? Everyone was told there was going to be a recession that hasn't occurred, right? And in a sense now, what I worry about is complacency. What the fact is now everyone's like, sure, it's not going to happen, and then it becomes more vulnerable. The lagging impacts associated with rates this high, take almost 2 years, right, to actually knock in. The Fed, when it reaches peak rates, typically holds them there for an average of 7 months. We're just coming to peak rates. So as we look to 24, you're going to have moderating demand on employment. You're ultimately going to have major sectors of the economy that are going down with inflation rates of 1% to 2%. Some parts, to Joe's point, are going to be higher. But we are absolutely headed down at that point. And that's one of the reasons why we love bonds at this point.
Yeah.
And obviously some stocks that have the kind of growth potential that you've seen.
Real quickly, in the last few moments we have, what would the stocks be that you also like here?
Well, I mean, there are areas that are so, for example, all of the small and medium-sized, industrials, manufacturing stocks that are relatively cheap at 14 times earnings.
Even despite a slowing economy.
Yep, mid-cap growth. Remember, next year is going to be the recovery year, a very tepid recovery year from where we are. Earnings are down, right, year over year by about 6%. But this was the first sequential growth quarter, first to second, right?
Yeah.
And as we get into 2024, that is going to be a moderate growth year, but we're going to have an earnings recovery due to the circumstances we've got.
Earnings recovery, macro slowing, wages slowing, budget. Listen, I'm going to try to put it all together, but I like your conclusion, so I'm not going to
No, but this is why people have to have a balanced portfolio and not keep so much cash. Because they're looking at all of these details and they're not taking a look at the overall trend, which is good for bonds and good for stocks.